Welcome to the Startup Funding Espresso. I'm Halti Martin, the host of this show where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Halti Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. In setting the valuation for a startup, there are financial calculations, and then there are non-financial factors. I call the non-financial factors the soft side of valuations. This includes the following. Current market conditions. As the market heats up, certain sectors turn hot and therefore command a higher valuation than the numbers indicate. Predictability. Companies with recurring revenue streams and long-term contracts command a higher valuation because the revenue is much more predictable. Customer concentration. Startups with a broader list of customers will survive longer. If a customer accounts for over half of the business, then this should be reflected in the valuation. Pre-profitability. For early-stage companies, those with profitability should command a higher valuation. Pre-revenue. For even earlier-stage businesses without revenue, intellectual property and customer forecasts come into play. Start with the financial calculation and then refine the valuation from there based on these issues. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start up something today. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.